Okay, here we go. Well, let's just review a little bit about what we've discussed so far this evening. We've talked about that the nature of capital financing is to find the cheapest capital to invest in assets which produce revenue, profit, and cash flow. And that there's two types of capital that we can use. One is called working capital, and another is long-term capital. And it's a balancing act of how we use these funds, both short-term capital, working capital, and long-term capital, and to determine the adequate financing and balancing of these types of capital fundraising makes a big deal in how much return is generated off those assets. The financial statements are the tools that tell us how we're making that return, what's our debt position, what's our cash flow, and are we succeeding in the financial strategies of the company. And then we went into discussing the tools of investment of debt and equity. And one of these tools is determining the value of money. The value of money either in the future or today relative to the asset and the revenue generation of that asset, and also the investment in that asset, the cost of the money to acquire that asset. The present value is determined by the amount of value of the money, the principal, the interest rate, and over how long of time period that goes for. And then we looked at an example of that asset in a spreadsheet format where we had an investment of $100,000 and that investment generated a cash flow or a profit of $140,000 over 10 years in these types of installments or per year. This $100,000 cost us 4%. Well, this $140,000 is the amount of money generated off this investment, but what is the value of this investment net today? So we learned, or we saw, how we discounted this cash flow back to today's dollars, which is usually called year zero, at a rate of 4%, and we came up with the calculation of $108,000. The net difference between that return, this is also called discounted cash flow, compared to the investment, gives us the return or the net present value of that return. So in a case of 4%, we're making $8,400. So that's pretty well what we discussed in the first part of our class of the definition of what that is. One of the measurements of a successful investment is that return off that investment over the number of periods and comparing that return in today's dollars to the initial investment. And we've done this before in other classes, I'm sure. So just to refresh our memories, that was a key part of the net present value, or the present value of a flow of money into the future. Excuse me. And how to determine its net in today's dollars. What determines this cash flow and what determines the number of years, we leave up to the bean counters, the accountants. The accountants determine the number of years of an investment based on its depreciable life. How long we can depreciate this asset, or what is the determined life of this asset? Determined by the industry, determined by history, the anticipated length of time of that asset. And then what's the difference between revenue and expenses, taxes, profits, cash flow generated off that investment is the return. And we'll talk more about these parameters of this analysis later on in our course. Now, our next topic this evening has to do with chapters 5 and 7. Chapter 5 concerns itself with a form of debt that many companies use, and it's called bonds. All right? Bonds are great for companies. Why? Because they're unamortized. There's an MBA word for you. Unamortized. What does unamortized mean? Principal is due at maturity. Only interest is paid during the life of that debt. Interest paid at maturity. All right? Where most of us, you and I, when we get a loan, It's an amortized loan. Why is it amortized? Because we don't have the credit or the collateral, so the bank or the credit agency makes us pay principal and interest every month. So principal is paid every month along with interest. That's an amortized loan. But if I'm a corporation, I have a lot of credit, a lot of collateral, a lot of assets backing up this debt. So what do banks or bond agencies do? They give us an unamortized loan, meaning it's okay, it's cool. Pay us the principal in 5 years. Just make sure you pay us interest every year until maturity. And that's unamortized. Boy, wouldn't it be nice to get in those situations? But we're too small. Only corporations can do this. Or if you have unbelievable credit. I would think if Warren Buffett started a new company today, and because it's new and nobody knows anything about it, I have a feeling Warren Buffett would get an unamortized loan. But if Rick Hassey went to Bank of America today and said, give me $1 million, I'm starting a business, they would say, Rick, who? Who are you? Are you that idiot that does those Zoom classes? Yes. All right, we're going to give you an amortized loan. You got to pay interest and principal, which most of us do anyways. So bonds are unamortized financing, and that's very attractive, especially if you have the collateral and the credit. Why? As I said, the only cash flow you have on paying off that investment or that debt is you just have to pay interest. You pay the maturity at the end of the life of the debt. Example, I borrow $50,000. Now let's be realistic. I take out a bond for $100,000. All right? And because of my credit rating and because of my position in the credit markets, they will give me a 10-year maturity. In other words, I don't have to pay that bond back for 10 years. And then they go price that bond in the market, all right? They go to potential lenders, potential investors in this bond issue of mine. Remember, a bond is sold in $1,000 increments. So I'm going to be selling 100 $1,000 bonds in the market. So you can buy one bond, you can buy 4, you can buy 10, you can buy the whole issue. But bonds are issued in $1,000 increments. And they price that bond in the market based on my credit rating, my history in the market, my ability to pay back money, and they give me a 6% rate. That's called my interest rate. And the coupon on that bond is paid semi-annual. In other words, I got to pay it every 6 months. So 6%. Let's say somebody buys the whole issue. So 6% is $6,000. So $3,000 per period is the interest on that bond. 6% a year. It's a semi-annual coupon, meaning the company pays it every 6 months to whoever they owe the money to. So that's 3% a period. 3% of $100,000 is $3,000, $6,000 a year. So somebody lends me $100,000 and I have to make sure I pay them $3,000 every 6 months for 10 years. Then at the end of those 10 years, I have to pay them back the $100,000. But the good thing about that is during those 10 years, I'm earning money off that $100,000 in wherever I invested it in, whatever asset I put that money into. And that money is generating return, hopefully generating return more than 6%. And then at the end of the life, I pay back the bond. Welcome to the world of corporate financing. It's just usually in hundreds of millions of dollars, not just $100,000. So that's debt financing. It's as simple as that. You go to the market, You determine how much you need to borrow. You go to the market, and the market gives you a credit rating. It determines what you can pay in interest. And then you attract your money, and you pay that money back in installments, interest every 6 months in this example, and the principal at the end of its maturity. Now, who does all this for you? An investment banker. They're the people that represent you in the market. USB, Goldman Sachs, Wells Fargo, JP Morgan Chase. Those are all famous investment bankers whose sole job is it, and this is where they make their money, is to find, they're the intermediaries between the company that needs the money and the people who have the investment dollars to invest in. They match them together. In return, the investment banker gets paid a fee by the company attracting the money, and also a fee by the investors finding them the money. What a racket. That's what an investment banker does. The intermediary to meet and match those people, the investors, with the investment. And what does the company do when they get this $100,000? They invest it in an asset that they anticipate to generate a lot more than a 6% return, and then they can pay back the money, and the company now has a new market position, a new asset position, and all is well in the world. The problem is, what happens if that $100,000 doesn't turn into a nice return investment? And you can't meet the interest payment, or you can't meet the $100,000 maturity. Then the bond goes in default, and you have to sell off assets to meet those obligations. Or you declare Chapter 11 bankruptcy, and you let the bankruptcy court sort out the mess, i.e. General Motors 2007 and 8. That's exactly what happened to General Motors. They had all these bond payments coming due, and they could not meet the obligation. They declared Chapter 11. And how did they come out of Chapter 11 bankruptcy? The United States government fronted them the money to pay off the bonds. President Obama, that was part of his Recovery Act, of giving some companies too big to fail. There's a movie about that, by the way. And gave them the money to pay off their creditors. And then the nice story about that is, which a lot of Republicans don't want to tell you, is General Motors paid all that money back, plus interest. And the government made money on that deal. Now, that was a risk, but it was a good thing. But that's what debt financing is. The bad thing about debt financing is they get paid first. Every 3 months, every 6 months, you got to pay it $3,000. Every 10 years, or when maturity, you got to come up with $100,000. If you don't come up with the dough, you're in big trouble. You either have to sell off assets to meet the obligation, or you declare Chapter 11 and you reorganize and restructure. So debt financing can be a good thing because most debt is very cheap. And also it postpones payments over many years. But at the same time, it can be an albatross hanging around a corporate's neck with those interest payments and that obligation to pay. So that's why some companies decide to issue stock, which is equity. The nice thing about equity and stock is you don't have to pay it back. It's not a loan. You are issuing ownership. Ownership, be it public or private. Private ownership, Mark Cuban on Shark Tank gives you $100,000. Public ownership is you find an investment banker, and that investment banker finds investors to buy equity stock in your company. Now you work for them. Ownership. But the good thing about it is you don't have to pay them. The bad thing about stock is now you have a bunch of owners represented by a board telling you what to do. And that sometimes ain't very fun. And at the same time, they have expectations. In other words, expected return. They expect something. Would you invest in Apple Computer, and if you knew in advance that they weren't going to pay, they weren't going to grow over the next 5 years or pay any dividends? I would say, you know what, Apple, I don't think you're going to get my money. You invest as an owner of a business because you expect to get paid. You expect to get a dividend. You expect the stock to grow. If you don't, that's why the market has bad days. People sell stock for two reasons. They're liquid. They need liquidity. They need cash, so they're going to sell their asset, stock. Oh, now I got the money. I can pay my my son's college education. Oh, I can pay my alimony this month. I'm going to sell stock. The second reason people sell stock is because they don't expect to make the return that they thought they would make. So they're getting rid of it. They're not expecting to make that return. Something has happened in the performance of the company, in the performance of the economy, whatever. So what happened last March when the stock market totally went down about 30% in one day? Is because there was a bunch of investors out there because of the coronavirus saying, I'm getting rid of my stock because the future doesn't look very bleak for me meeting my expectations. So there were more sellers than buyers, and the market fell. Well, what happened last week when the stock market went up? The Dow went up 1,200 points. Because all of a sudden people thought, states are loosening up their restrictions. Companies are going back to work. People are going to have money to spend. The NBA is going to start up in July. The hockey playoffs are going to happen. I'm feeling a little bit more confident about the future, so I'm going to start buying stock again. There were more buyers than sellers, so the stock went up. It's totally the opposite in the bond market. People buy bonds to hang on to them. I want to get that interest payment every 6 months. I want to get my money back in 10 years. Everything's guaranteed. That's the attractiveness of bonds. That's why companies have more bond debt than stockholder equity in some cases. Why? Because companies can get a handle on it. They know exactly what is demanded by them. They can put these numbers into their operating budgets, into their cash flow budgets. But in stock, it's an unknown. Are we going to do good in 10 years? Are we going to do all right? I have no friggin' idea. Now, the reason you invest in stocks is based on their track record, the history. The products, are they competitive? One of the weirdest things over the last 10 years in the equity markets is people buying stock in Tesla, the electric car company, SpaceX. When the hell are these people going to make a profit? It finally took Tesla 10 years to make a profit. They've made a profit the last couple of quarters. 10 years of losses. Why would you invest in Tesla? Why? The future. I'm willing to not make any money now because I'm going to make money in the future. When I'm long gone and you guys can visit me at my grave in 10 years or whenever, there's going to be no more automobiles powered by gasoline. It's going to be electric. And guess who's going to be selling a lot of electric cars? Tesla. In about 10 years, we'll be having outposts on the moon and Mars. I will not be here, but we'll be having outposts on these different planets. Who's going to be a leader in that? SpaceX. It's the future. So that's why so many people buy Tesla stock at those ungodly $500-600 prices, because of the future. They're willing to wait. And Peter says that's exactly the same as Amazon, and he's exactly right. The good thing about Amazon that's different from Tesla is Amazon's making its money now. Just got a little text on my phone 5 minutes ago. Your Amazon delivery is at your door downstairs. And they put a little picture. So I see here in my office while I'm teaching you a little picture on my phone. Oh, my box is downstairs. They have mastered their industry already. Tesla still has a way to go. But people are willing to invest in Amazon, and you're right, Peter, because they're making their money now. So the key to stock is expectations. If you think the company's going to do well, keep on buying the stock. If you think the company is not going to do well due to the industry, the market, the economy, get rid of it. Sell it. Try something different. Put your money elsewhere. The problem with today in our recessionary economy is there's no other place to put it except the stock market. And that's except for gold, maybe buy currency, US currency, but there's not much money in other places to put your money. And that's why the stock market has its good days, but over the last month or so, it's had very good days. It's almost taken back what it lost in March, because there's no other place for people to invest their money and get their expected returns. So if I'm a CFO, that's a good thing. Because if the stock market's good and my stock price is doing good, that tells the world thinks I'm running the company well. Anybody seen the value of Radio Shack lately? Anybody see the value of J.C. Penney lately? Oof. Why? People don't think they're going to do well. The stock has fallen to the basement. So stock is expectation. You're right, Efron. Amazon still has room to grow. Why? They're gaining more and more market share every day. It's amazing. I was talking with my wife the other day. We see in our neighborhood here in West Claremont, every day, more and more delivery trucks from Amazon in our block. I don't know what the hell these people are ordering, but it's every day. Amazon, UPS, Federal Express, whatever. You're right, Efron. They're being more with technology. They're becoming more efficient. They're going into more markets. We have a neighbor across the street every other day gets food delivery by Amazon, groceries. So you're right. You want to go with the companies or be with the companies or find those companies and be a CFO of those companies where you have R&D, research and development, marketing analysis, industry analysis, economic analysis that keeps you way ahead of your competition, because you'll attract the capital dollars. Radio Shack? Don't think so. Now, even in some industries, some companies do well and some companies do bad. It's not just the industry. Look how Zoom has done over the last few months. You invested in Zoom in March and sold it last week, you'd make about $9,000 on 100 shares of stock in about 6 weeks. Lord have mercy. Why didn't I figure that one out? So again, this is a key for us as managing financial resources. If we find our capital from stock, we have to meet investors' expectations. If we fund our capital by debt or bonds, we have to make sure we have the cash flow and the return to pay back as soon as possible, depending on the bond agreement, the interest and the principal. We're locked in, but we know exactly what we have to do with debt financing. But in equity financing, it's meeting the expectations. You can say you're going to make 10% profit this year, but if you don't, what's probably going to happen to your stock? It's going to go down. Every company, public company in America, is required by the Securities and Exchange Commission every 3 months to report their returns, their financials for the last quarter, and their financial projections for the next 12 months. And if they don't hit those projections, usually their stock falls. Remember last year, Apple had like a $10 billion quarter. They made more money than ever, but their stock went down. Why? Because the CFO of Apple expected them to make $11 billion. They were off $1 billion. So the stock price fell. Investors said, geez, you guys pulled a fast one on us. You didn't say what you were going to do. You made $10 billion friggin' dollars. Investors want their expectations met. So that's a key thing. And that all relates now to chapter 6. The expectations of bonds, the expectations of stocks is all based on risk. Oops, wrong area. Is all based on risk and return. What are the risks of making your expectations? And what is that return? Is it valuable enough for those risks? That's huge. You know, about, geez, how old am I? About 45 years ago, I was scratching my head on one Friday night going, you know, should I get married tomorrow or not? Should I get married tomorrow? What's the risk? I'm going to live with this person for the rest of my life. That's not such a bad risk. She's a wonderful woman. I have to live with this person for the rest of my life. What's the return? I have to live with this person for the rest of my life. That's a good thing. So I married her. We're still married. How she keeps up with my lunacy is beyond me. She has more risk than I do. But that's a key question. Are you willing to accept the risk and the return? Be it a bond investment, be it a stock investment, and does the CFO and the financial managers who are managing the assets to produce and pay off these investments, do they gauge properly the risk and return of the market? To be a great financial manager, to be a great financial analyst, you not only have to read financial statements, you not only have to calculate present value, you also have to calculate risk and return. In the market, the industry, the economy you're in. Right now, risk is a little high for some companies because of the recession, a slowdown. But for other companies, right now, risk and return is great. Example, Zoom. Example, repossession companies. Oops, sorry, I brought that up. But if I own a repossession company, I'm kind of pretty busy these days. Why? A lot of people, I know this is a bad example, but it's true. It's an example of in some downturns, like a recession, other companies do very well. Well, what type of company am I? Do I do good in a downturn? Probably not, but I might do well in a downturn because of the nature of my business and industry. And also, what do I have to protect my risk? Do I have a lot of cash positions? I can make some risk in today's market because I got a lot of cash to back it up. Or I have low and cheap credit. But if I don't have those things, my financial strategy is totally different. If you were just laid off from your company and you had a great opportunity to buy a house, would you? When you have no guarantee of income in the future. But I got $400,000 sitting in my bank account. Ooh, that can make that decision a little bit easier. I could pay cash for my home. But do I want to spend all that cash and take the risk of buying a home with no income and all my cash is gone? Oof. That's exactly the strategy that companies have to deal with. What's the balance of risk and return? Risk is measured by a couple of things. One, it's a statistical calculation, beta. Some of you have had the luxury and the enthusiasm of having statistics with Professor Hasse. Talk about a boring class. But what does statistics and beta tells us? It tells us the history of our risk over the last few years. A beta. If I have 0 beta, I have no risk, no problem. If I have a beta of 1.0, I have average or market risk. If I have a beta of 10, I'm the government of Greece. I got bad credit. 0 risk means I have, a 0 beta means I have no risk. A 1.0 beta means I have average or market risk. Most of the companies in America have a beta between 0.5 and 2. 0.5 and 2. Beta is a statistical calculation comparing your returns to the market returns. And if you have outperformed the markets, your risk and deviation is going to be low. If you have underperformed the markets, your risk and your standard deviation is going to be high, thus your beta will be high. Beta is not the future. That's the problem. Beta is the past. That's the past. So that's one calculation for risk. Another calculation for risk is naturally our credit score. For corporations, that's Moody's, Fitch, Standard & Poor's. They're the rating agencies for corporations. That's another way of determining risk, your credit rating. You know this. If you have an 800 FICO score, you're probably going to get a very cheap loan. But if you have a 500 FICO score, you're going to have to pay for it. Probably shorter term, higher interest. Same thing for corporations. If I have a AAA rating, my world is my oyster. But if I got a C- rating, I'm in trouble. So credit ratings are another way of determining risk. Beta and credit rating, credit score. And finally, the third method of determining risk is expectation analysis. And that is called the capital asset pricing model. Determining your return in the future. Can I estimate my return in the future? The capital asset pricing model is a theory, is a formula that's based on today's numbers and looking into the future. I'll say that again. It's a calculation of what you expect to earn in the future based on today's risk and return. And some of you have studied this in classes, but I'm going to go over that now because we're going to be using this capital asset pricing model quite a bit throughout our class. Excuse me. What is the capital asset pricing model? Well, it's defined in chapter 6, just so you know. There's a couple of videos in this week too that talk about it. You should look at those videos. But what it is, in English, it means this. My expected return is equal to the risk-free return plus market premium return times the beta or the risk of my company. That's it in English. Expected return is generated by determining the risk-free rate of return, adding that to the market premium return. Nice spelling, Mr. Hasse. God, you think I've been drinking all day the way I'm typing tonight. The market return times the beta, the statistical calculation of risk for our business today. Now I'm going to do something. Watch this. Can I do this now? Yes, I can. I got a chat question. Yes, Mr. Khan, the company's future profits do have a picture of the future, okay? But that, if you're reading in chapter 7, that is called the, let me write this down here so you can see it, is if in the case of stock, okay, you can determine, every company has to determine their return in the future. And that return is used to determine future value. And that future value can drive and determine the price of a stock in the future, okay? It's called the, as I said earlier, where's my notes? Sec. I just had a brain freeze, hang on. That is called the constant growth model, where the price of stock today is based on its future cash flow in the future. I'm going to talk more about that next week, but that's a good question. But let me go back to where I was heading. This is the one last thing, and then we'll probably wrap it up by 8:30 tonight, guys, just so you know. So let's bring this up here. So let's say I wanted to determine whether I should invest tomorrow morning in Ford Motor Company stock. All right. Or let's say I'm the CFO of Ford Company and I want to know what my expected returns of the market is on my stock. Is it good or bad? So I go to my Google Chrome and I type in Yahoo Finance. And I go to Yahoo Finance and I look up Ford Motor Company. There it is right there. And it told me that the stock was trading today at $6.50, but it tells me a couple other things here. Look at this. Ford Motor Company's current beta is 1.3. Okay, 1.3. All right, cool. I'm going to write that down. 1.30 Ford's current beta. That's their current risk in the market. A little bit below average, 1.3. All right. Then I go to the Wall Street Journal. So I'm now in the Wall Street Journal, and I want to find out what the current 10-year United States Treasury yield is. So I go to markets. Oop, there we go. I go to markets and I go to bonds. And I go to treasury yields, treasury markets. And it tells me that the current 10-year United States Treasury note is 0.761%. Ladies and gentlemen, that's the risk-free interest rate. The 10-year United States Treasury note is 0.761%. In other words, if I buy a $1,000 10-year United States security today for $1,000, I would get a little bit less than 1% interest on that note every year for 10 years. So what's 10% of 1,000 is 100. 1% of 1,000 is 10. If I give my money to the United States government, they will be giving me $7.61 a year for the next 10 years. That's the current yield. That's the current interest rate for the risk-free interest rate. Okay, so we get out of that. And now we go back to my spreadsheet. Oh, did I lose that? Oh, there it is. So I just determined that the risk-free rate is currently 0.761%. I just determined that my beta from forward is 1.30. That's the risk-free rate and the beta risk of my company. What is the market premium? Well, the market premium is the current yield on the S&P 500. That's the market. The S&P 500 index, the current yield. So the S&P 500 index, I looked this up earlier, didn't want to take up too much time, is currently 6.1%. That's the current yield on the market. The market premium is equal to 6.1%, the market return, minus the risk-free rate, 0.761%. That difference is called the market premium. It's the spread between the market return, which has a beta of 1, and the risk-free rate, which has a beta of 0, that spread. That premium is going to be multiplied by the beta of Ford. So let's put that into a formula. Equals 0.0761 plus parentheses 0.0610 minus 0.00761 times 1.3. In other words, I'm taking risk-free rate plus the market premium. These are all decimals of those percentages. And I'm multiplying that spread, that premium, times the risk-free rate. And I get 14.51%. Wow. Let's put that into a percentage. 14.455%. That's the capital asset pricing model. You can see the formula there, and when you look at the spreadsheet later, you can see it. In other words, if I wanted to invest in Ford Motor Company today, tomorrow, I'm expecting in today's markets a return of 14.5%. Why? I can get 0.76% for no risk. I can get 6.1% for average risk. I can get 14.5% for Ford's risk. All right. That means that's why Ford stock is not very high. A lot of people aren't buying Ford stock these days because they don't think Ford is going to make a return on 14% of their money in the future. Okay. That's another way of determining risk and expectations. Calculating out the future return of Ford based on the risk in the market of the current market structure. Not good. Not good for Ford. Now, if this was Apple Computer and the return was 14.55, maybe I would think maybe Apple and Amazon can generate those kind of returns. But Ford Motor Company does not. Of course, Apple and Amazon's betas are a lot lower than Ford, less risk. So when we're talking about in these 4 chapters, how to get capital, how to get financing, how to determine its value, we look at the sources of capital like bonds, like stocks, and the risk of those ventures, especially stock, in the market determined by beta, credit score, and financial or expectation analysis. Next week, we're going to lump all these together and refer them to the financial statements of a company. How all these things come together to give us a picture of the financial aspect of a company. Before we make an investment, before we are a CFO and we want to invest or go out and attract capital, are we in a position with low risk, average risk, or high risk? What are our financial positions look like to generate that investment in the market? That's what we're going to talk about next week. And that's what you're going to put together in your PowerPoint presentation next week. I'm going to give you a situation where you're going to analyze risk and return. And we'll talk more about this next week as well. Chat question. No, remember the risk-free rate in the market is 0.76%. All right. What is the decimal for 0.76%? 0.0076. Remember, the decimal for 1% is 0.01. The decimal for 10% is 0.1. The decimal for 0.761% is 0.006761. Got to add 2 zeros to it. Got another chat question. So Vivian, is that okay? Did I answer that question? I think I did. And Daisy asked a question, can you explain one more time why 14.55% is high for Ford? Well, because Ford has not been making hang on, a couple more chat questions. Yeah. Oh, thank you. Thank you, Stephen. Stephen just caught me. Thanks, Stephen. Here we go. Back to this capital asset pricing model. Thank you, Stephen. I goofed. I need to add another 0 to the risk-free rate. I had 0.0761. It should be 0.00761. Thank you, Stephen. If I redo that number, our return, thank you. It becomes a lot lower, 7.7%. Thank you. Thank you, Stephen. Appreciate that. Going back, I had one few zero here. I had to make sure it was 0.00. So that made this now not 14.55, 7.7%. Thank you. Thought that was a little high. Appreciate that. Now, the next question that Daisy asked is, well, what does that mean for Ford? Well, last year, for the year ending December 31st, Ford Motor Company had a return of 2%. profit margin. 7.7% is a pretty tall order, especially when you look at their quarterly numbers. So the reason Ford stock has been low, historically low for the last couple of years, is they have not been generating enough return to merit the risk of the company. Thus, the interest rate or the capital asset pricing rate of return or expected return is a lot higher. People are staying away from the stock. Now, some people buy Ford stock because they like the management. They like the products. But I own stock in Ford now because I've owned it for thousands of years. But if I had some spare money now, I would not be investing in Ford stock. I don't think they'd be making 8% this next year. It ain't going to happen. So I'm going to find an investment that meets my expectations, but is worth the risk. So that's what that means, Daisy. And it's a little bit better than the 14.55, but the 7.7 is still pretty ugly for Ford because they only generated, matter of fact, last quarter, Ford lost money. Thanks, Vivian. Yeah, I did make a typo. Okay. So I'm going to stop right there for the part of the lecture talking about this material. But just so you get a feel for, we use the present value of money to determine a calculation of dollars today compared to future returns. We use the concept of bonds and the investment or the financing of bonds, knowing that we know what our payments are going to be and knowing when it is due. We make the investment or attract stock as an investment in our company, knowing that we don't have to pay out much cash flow, but we're expected to make a return into the future or our stock is not going to hold its value. And these all place a decision based on why investors are going to, and the balancing act that we do, here's my hands, the balancing act that we do on how we finance assets for investment. And plays on all of this on both sides, the risk factor. What's the risk of our company in the market? What's the risk of the credit score in the industry? And what's our expected return based on the risk in the market? What do investors want from us? That's an important concept. And next week at the beginning of the class, we're going to talk about the constant growth model, which is another way of expecting or determining stock valuation in today's market based on expectations of profits and return by the individual company, where beta is not a key factor. Another way of looking at it. We'll do that next week. So all these definitions, present value, bond financing, equity financing, risk and return, are all going to make up discussions that are going to take place in your first case next week in a PowerPoint presentation. But I'm going to talk about examples of that in our class next week. Your job in the future week is to make sure you give an example of present and future value or bonds or stocks as an investment. You individually, from your experience, maybe looking it up, give an example. And don't everyone pick investing in a savings account or a certificate of deposit. Be a little bit creative. Oh, I want to buy a bond. I'm going to buy some stock. How do I determine its value in the market today? What's the present value of stock? Well, you can use the constant growth model. But we'll talk about that more next week. But I want you to, in the discussion forum this week, give an example, and then have your fellow students and you pick two other students to comment on constructively, pro or negative, about their example. That's your job this week. And then a couple other things. Let me bring up the agenda here, excuse me. So I'm going to post this spreadsheet to week number 2 folder as soon as I'm done tonight, so you have that to follow. Another chat. You guys are chatty tonight. Peter wants me to explain the market premium once more. No problem, Peter. Hang on. The market premium is the difference between the S&P or the market rate of return and the risk-free interest rate. It's the premium. It's called the spread or the premium. In other words, the market premium is defined as the difference between the market premium return or the market rate of return. As of this morning, the rate of return in the S&P 500 was 6.1% on average. The risk-free rate this morning in the market for the 10-year United States Treasury yield was 0.761%. The difference between those two is called the market premium. The difference between the risk-free rate and the market rate of return. Now, not to add confusion to this, but many people, remember I told you last week that finance is interpretation. Well, some people interpret that the risk-free rate is the 30-year United States Treasury yield or the 5-year United States Treasury yield. Some people interpret that the market rate of return is the NASDAQ rate of return. It's your interpretation, but either way, both are right. It's you and just interpret different rates to represent those numbers. In our class, the risk-free rate is the 10-year United States Treasury yield. In our class, the market rate of return, which will be always given to you, will be the S&P 500 return. So that's just something to think about. Okay, Peter, market premium. Let's bring back our agenda. So next week we have discussion post number 2, which is due Sunday. And again, one example of present value, future value, and then 2 evaluations of a fellow student. Also next week, we're talking about chapters 3 and chapters 12. Quite a spread there. Chapter 3 is about financials. The balance sheet, the income statement, the statement of cash flow. Kind of like the video I gave you this week. The financial statements, just a refresher on those. we're going to review a financial statement of a company next week in class. And then chapter 12 is about taking the financial statement information and projecting that out into the future. It's called the additional funds needed model from chapter 12. AFN model. Taking your financial data and projecting it out into the future. Why is that important? Because it's going to tell you how much additional capital I need to raise in the future to keep my financials strong, make profits. Remember, growth is the key for valuation. If I'm not growing, I'm not getting bigger, not increasing my value. How do I grow? I need new capital. How much capital do I need? The additional funds needed model is one of the ways of calculating that. We'll go over that next week in class. So basically next week is kind of like a semi-accounting class without the debits and credits, thank God. But we'll look at financial statements and projected financials into the future, chapter 12. And then you have a case study where you'll be taking a look at risk and return, capital financing in a particular scenario, and putting together a PowerPoint presentation to show your interpretation of that data. And again, we'll talk much about that next week. What I'll do in week number 3, early this week, is I'll post the financial statement that we're going to review so you have a chance to look at that. If any of you have a textbook, I would strongly urge you, if you do have a textbook, in chapter 3, to take a look at page 119, I believe. It's the analysis of financial statements. If it's not, it's around 115, 119. I'm sorry, I don't have everything here. But you want to look at it's called a table, 3-1, and it gives you a table of all different types of financial ratios. We're going to look at those financial ratios next week from that one page. It shows examples of all the key financial ratios for a company. All right, and I'm also going to post those ratios to the Blackboard, so you have those for some of you who don't have a textbook. All right. Let me make sure I have everybody accounted for this evening. One other person came into the group. One other person. Who was that person? Let me take a look here. Andres, are you here? Andres, Emmanuel, Steve is here. There she is. It's Alicia. Hi, Alicia. Okay, so everybody's accounted for. One last chat question. Yes, you can. Joey asked, can we do mortgage loan refinancing for our time value assessment? Yes, you can. That's a good example of that. Mortgage loan refinancing. That's fine, Joey. Please go ahead and do that. That's a good one. Okay. Remember, our office hours are Wednesday afternoons from 3 to 5. If you have any issues that you want to talk to me about, you just click on that link in the Zoom links file folder and you're there. Also, if you can't make it during those time periods, just send me an email or a text. And if you want to speak in person, we can set up a Zoom meeting. If not, we can just answer it through the email via. Anybody have any questions or concerns this evening? You guys are too easy. All right. Again, let me remind you, it's not always going to be this slow and even pace. We are going to pick up our learning as we move along. But again, these first few weeks are getting back up to speed with some financial tools, definitions, explanations, theories, applications. And then this is all going to come to a head as we head into the mid part of our course in 4 and 5. This is to get us up to speed and make sure we're ready to tackle those strategic issues. Again, I have recorded this class this evening, so you have that available to you to review. If nobody has any questions, I thank you all. Maybe I'll see some of you during the week. If not, I'll see you all next Monday, and thanks for your participation. Adios.
Thank you.
See you guys.
Thank you.
Thank you, Joanna.
Yeah.